Qatar LNG disruption, a strategic lesson for the global gas markets. Here's our today analytical discussion. We'll cover this topic. Hello and welcome to Energy Insights, where we break down the energy events and analyze their market implications. Today, we are examining a development that's more than just a supply disruption, which is the Qatar Ras Laffan LNG complex, a critical hub for the global gas, has been damaged during the ongoing conflict in the Middle East. This event is significantly not important just for short-term supply, but because it exposes structural vulnerabilities in the global LNG markets and highlights the geopolitical risk shaping the energy strategy worldwide. So we are dividing our today's analysis into various segments. So starting from the immediate disruption, the Ras Laffan complex accounts for roughly 20% of the global LNG exports. Damage to this facility has immediately removed a substantial volume from the market. Analytically, this is not simply supply shortage; it is supply shock concentrated in a single high-volume source, which amplifies price volatility. Historically, data shows that when a major LNG hub goes offline, spot LNG prices can spike 20 to 40% within weeks, and the ripple effects are felt across all major importers. This is especially important because Qatar LNG has long been considered reliable, giving buyers confidence in long-term planning. This confidence is now apparently looks to be shaken. So under the segment two, the price and the market dynamics, let's consider the market response to this event. Number one, spot LNG markets are under immediate pressure. With limited supply, Asian and the European buyers are bidding aggressively, driving short-term prices higher. Analysts now expect Asian spot LNGs to exceed $26 per MMBTU, a significant jump from the pre-conflict levels. Hedging and contract dynamics. Number two. So countries with long-term take or pay contracts are partially insulated, but their flexibility is limited. They may face contractual penalties if they cannot take volumes while the market reallocates supplies. Number three, structural implications. This disruption may force global traders and the governments to reconsider how much supply they rely on a single region, potentially accelerating diversification strategies toward the US, America, Africa, and Australia. Now, under the segment 3, we are looking to the geopolitical risk and energy security. Beyond the immediate market shocks, this event underscores a critical lesson, which is the energy security is inseparable from the geopolitical stability. The Middle East remains volatile and the energy infrastructure is target. Shipping choke points like the Strait of Hormuz face increased risk, threatening both the oil and gas transport. Countries dependent on imports without flexible logistics are now exposed to geopolitically arbitrage. That means that they must pay higher prices or face shortages. This creates a clear analytical insight. Energy planning must account for a geopolitical risk premium, not just physically a supply and demand anymore. So under the segment 4, we are looking to the impact on the emerging economies. Emerging economies, including Pakistan, are mostly exposed because they rely on spot purchases or they may have limited storage availability. Analytically, the consequences are price inflation, immediate cost increases for LNG imports, which may strain budgets and impact electricity tariffs. Supply risks, limited flexibility to adjust a procurement if long-term buyers outbid them. Strategic vulnerability, infrastructure constraints prevent rapid rerouting or supply substitution. Countries like Pakistan may need to rethink LNG procurement strategies, including hybrid model that combine long-term contracts, part flexibility, and innovative logistics like a short-term supply through virtual arrangements. And particularly the storage is now a very key for the emerging economies. This is one thing which has been erupted from this development. Under the segment 4, we are looking to strategic insight and lessons. From an analytical standpoint, there are several lessons for policymakers and industry players. Number one, diversification is critical. Relying on a single country or hub increases exposures to supply risks. Number two, hybrid supply models combine long-term agreements with flexible, decentralized logistics enhances resilience. Number three, private sector innovation, virtual projects, storage expansion, and the flexible regasification can mitigate geopolitical and market risks. Price risk management, hedging, and strategic stockpiles can reduce vulnerability to certain spot market spikes. The bigger takeaway is that energy security and market strategy must now account for geopolitics, not just supply and demand costs. So long-term market implications is the under the segment 6 we are covering today, which is looking ahead. Uh, Global LNG flows may permanently shift toward more diverse suppliers. Spot market volatility is likely to increase with price spikes becoming more frequent. Emerging economies will need to adapt, focusing on resilience rather than just affordability. In short, this event is not just a temporary supply disruption, it's a strategic inflection point for the global gas markets. Uh, so overall, what we conclude today that is the Qatar LNG strikes illustrate that energy markets are not only driven by supply and demand, but also by geopolitics, infrastructure, and strategic planning. So that's about the today analysis. Stay tuned to Energy Insights for expert analysis and actionable insights on energy markets. Don't forget to like, share, and subscribe to stay informed.